Everyone is talking about AI stocks hitting all-time highs. NVIDIA, Microsoft, the whole sector. But we have seen this movie before. In 2000, it was the dot-com bubble. In 2008, it was housing. Now everyone is asking the same question. Is the AI bubble about to burst? I am going to show you the data that Wall Street is not talking about, when this rally might actually hit a wall, and exactly how you should be positioning your portfolio right now so you do not get caught on the wrong side of the trade. I am going to break this down into 5 parts. First, the euphoria phase and where we really stand today. Second, the warning signs that most investors are ignoring. Third, the historical comparisons that will make you think twice. Fourth, the 2 possible scenarios for where we go from here. And fifth, your detailed action plan with specific steps, position sizing advice, and the exact numbers I am using for my own portfolio. If you want to stay ahead of the market, hit that subscribe button and turn on notifications. We are deep diving into the Wealth Lab market analysis right now. Let me be clear up front. Nothing in this video is financial advice. I am not your financial advisor. This is for educational and entertainment purposes only. All investing involves risk, including the potential loss of principal. Do your own research or consult a qualified professional before making any investment decisions. The strategies I discuss may not be suitable for your specific financial situation. Now let me start with part 1, the euphoria phase. And I want to go deeper than the surface level numbers. Everyone knows the Nasdaq is up. From the October 2022 low to today, the Nasdaq has gained over 70%. That is not a normal rally, that is a parabolic move. In the history of the Nasdaq, there have been only 4 other periods with gains this large over a similar time frame. The late 90s dot-com run, the 2003 to 2004 recovery after the dot-com crash, the 2009 to 2010 recovery after the financial crisis, and the 2020 to 2021 pandemic stimulus rally. 3 of those 4 periods were followed by significant corrections within 18 months. No, let me give you the valuation numbers that actually matter. The current forward price to earnings ratio of the Nasdaq 100 is sitting at roughly 28. That is not the highest it has ever been. In fact, in 2021, it was over 35. But here is what matters. The only other times the P/E ratio has been this high without a recession were right before the dot-com crash and right before the 2022 bear market. That is 2 for 2. Every time we have been at these levels without a recession already happening, but valuation alone does not kill a bull market. What kills a bull market is a combination of high valuations plus a catalyst. In 2000, the catalyst was the Fed raising interest rates and the beginning of the earnings recession for tech companies. In 2022, the catalyst was inflation spiking and the Fed hiking rates at the fastest pace in 40 years. So the question is not just whether valuations are high, the question is what catalyst could trigger the next downturn. Let me give you a direct comparison to 2000. Back then, companies with no revenue and no business model were going public and doubling on day one. Sound familiar? We have seen that again with some of the AI penny stocks. There is a company called Applied Digital that changed its business model to AI cloud computing and saw its stock go from $2 to $15. That is a 600% gain. They have almost no revenue from AI today. I went public via Spark and saw its stock triple on hyperloan. They have negative earnings and negative cash flow. The difference is that today the big players like NVIDIA and Microsoft actually have massive earnings. NVIDIA grew revenue over 100% last year and is on track to do it again this year. Microsoft has a 40% operating margin and a $1 trillion balance sheet. In 2000, Cisco had great earnings too. Cisco was the NVIDIA of its time. They dominated networking hardware, just like NVIDIA dominates AI chips, and Cisco still dropped 80% from its peak. It took Cisco 15 years to get back to its 2000 high. So the comparison is not perfect, but the warning signs are similar. What is different this time? The big one is that AI is already generating real revenue at scale. The dot-com companies were selling pet food online at a loss and spending billions on advertising that never produced profits. NVIDIA is selling chips that every major tech company is fighting to buy. The demand is real. The revenue is real. The cash flow is real. That fundamental difference means that even if a bubble exists, it is likely to be narrower. The winners might keep winning while the speculative garbage gets destroyed. That is actually the most likely outcome. We saw this in the 1970s with the Nifty 50. Those were 50 large cap stocks that everyone thought were invincible. They got crushed in the bear market of 1973 to 1974, but many of them, like IBM and Coca-Cola, went on to make new highs within a few years. The ones that never recovered were the speculative names with no earnings. So that is the backdrop. High valuations, strong earnings from the leaders, and a lot of speculative froth in the smaller names. Now let me move to part 2, the warning signs that most investors are ignoring. I am seeing 5 specific red flags that tell me we are late in this cycle. Not necessarily at the very top, but late. Warning sign number 1 is semiconductor inventory. If you look at the earnings reports from major chip manufacturers, their days of inventory outstanding has been climbing for 3 straight quarters. That means chips are sitting on shelves longer before being sold. When inventory builds up like this, companies eventually cut orders. And when they cut orders, semiconductor stocks get crushed. Historically, a peak in inventory levels has preceded every major semiconductor downturn in the last 20 years. The inventory peak in 2018 preceded a 50% drop in the Philadelphia Semiconductor Index. The inventory peak in 2021 preceded a 40% drop. We are seeing that pattern again right now. Warning sign number 2 is the memification of AI stocks. I am seeing stocks with no revenue, no product, and no team pumping 10,000% because they added artificial intelligence to their name. There is a company that changed its name to something with AI in it, and the stock tripled. They had no AI technology at all. That is pure speculation. That is exactly what happened in 2000 when public companies added Dotcom to. The fact that this is happening again tells me the froth is real. When you see companies pivoting their entire business model just to chase a hot sector, that is a classic late cycle signal. Warning sign number 3 is retail investor sentiment. The American Association of Individual Investors survey just reported that bullish sentiment is at 54%. That is well above the historical average of 38%. Bearish sentiment is at only 20%. When everyone is bullish, there is no one left to buy. That is when markets correct. I am not saying the top is here today, but when sentiment gets this lopsided, the risk of a sharp pullback goes up dramatically. There is a reason why contrarian indicators work. The crowd is usually wrong at major turning points. Warning sign number 4 is insider selling. This is a signal that almost no one talks about, but it is one of the most reliable insiders at major tech companies have been selling shares at a rate not seen since 2021. The CEO of NVIDIA sold over $700 million worth of stock in the last 12 months. The CEO of Amazon sold over $3 billion worth. The CEO of Meta sold over $400 million worth. Now, I am not saying they are selling because they think the top is in. They sell for many reasons, including diversification and tax planning. But when you see this level of insider selling across multiple companies, it is worth paying attention to. Insiders know their business. Warning sign number 5 is the concentration of the rally. The top 10 stocks in the S&P 500 now account for over 35% of the entire index. That is the highest concentration since the 1970s. The last time concentration was this high, the market experienced a lost decade of returns. When a few stocks drive all the gains, the market becomes fragile. If something goes wrong at NVIDIA, or Microsoft, or Apple, the entire index gets dragged down. Diversification is supposed to protect you from that. But when the index itself is not diversified, that protection disappears. No, let me add a sixth warning sign that is more technical but important to understand. The put-call ratio on tech stocks has been falling for 6 months. That is a fancy way of saying that fewer investors are buying protection against a market decline. When the put-call ratio gets too low, it means everyone is comfortable, everyone is complacent, and markets are most dangerous when no one is worried. The put-call ratio today is lower than it was before the 2022 crash. That is a red flag. So those are the warning signs. High valuations, inventory build-up, speculative mania, extreme sentiment, heavy insider selling, dangerous concentration, and low put-call ratios. Any one of these alone is not a reason to panic. But when you see all 6 at the same time, you have to acknowledge that the risk is elevated. Now let me move to part 3. The historical comparisons that will make you think twice. Let me take you back to 1999. The internet was changing the world. Everyone knew it. Every company needed a website. Every investor sounds familiar, right? In 1999, the Nasdaq rose 86%. Then from its peak in March 2000, it fell 78%. It took 15 years to get back to that peak. But here is what most people forget. The internet did change the world. Amazon, Google, and Apple became some of the most valuable companies in history. The problem was not that the problem was that valuations got too far ahead of reality. Amazon dropped 95% from its 1999 peak. If you bought Amazon at the top of the dot-com bubble, you would have been down 95% before eventually making money again more than a decade later. That is the danger of a bubble. You can be right about the technology and still lose almost all your money if you buy at the wrong price. Let me also compare to 1972. That was the peak of the Nifty 50 bubble. These were 50 large cap growth stocks that everyone believed were immune to economic downturns. They included companies like IBM, Xerox, Polaroid, and Coca-Cola. The Nifty 50 traded at price-to-earnings ratios of 40 to 50 times, not far from where some AI stocks trade today. Then the 1973 to 1974 bear market hit. The Nifty 50 dropped an average of 65%. Many of them took a decade to recover. The lesson is that even great companies can be terrible investments if you pay too much for them. Now, let me compare to 2021. That was the last time we had a bubble in speculative tech stocks. The ARK Innovation ETF, which was the poster child for the bubble, peaked in February 2021 and then dropped 75% over the next 18 months. Stocks like Zoom, Peloton, and DocuSign dropped 80 to 90%. The difference between 2021 and today is that in 2021 the Federal Reserve had interest rates at 0. Today rates are at 5%. That makes high-growth stocks even more vulnerable because their future earnings are worth less in today's dollars. So history tells us 3 things. 1. Bubbles can last longer than you think before they burst. 2. When they burst, the declines are severe. And 3. The best companies eventually recover, but it can take years or even decades. Now let me move to part 4, the 2 likely scenarios for where we go from here. Scenario A is a soft landing. In this scenario, the AI trade continues, but at a slower pace. The big names like NVIDIA and Microsoft pull back 10 to 15% over the next few months. Then they consolidate for a while and resume growing at a more reasonable rate, say 15 to 20% per year instead of 100%. This scenario usually happens when earnings. It requires that the Fed successfully navigates a soft landing for the economy. It requires that AI demand remains strong, and it requires that no external shock, like a war or a banking crisis, hits the market. This is the most common outcome in a bull market. The market goes up, corrects a bit, catches its breath, and then goes up again. But scenario B is the one that keeps me up at night. The bubble burst. In this scenario, something breaks. Let me give you 5 possible triggers. Trigger 1. A major tech company misses earnings badly. Not just a small miss, a big miss that forces analysts to slash their forecasts for the whole sector. If NVIDIA reports a quarter where growth slows from 100% to 50%, the stock could easily drop 30% in a day. Trigger 2. The Federal Reserve hikes rates again, or signals that rates will stay high for much longer than expected. The market is currently pricing in 3 rate cuts next year. If the Fed says they are only cutting once or not at all, that would be a massive shock to valuations. Trigger 3. A geopolitical event. China invades Taiwan and disrupts semiconductor supply. Taiwan produces over 60% of the world's advanced chips. Any disruption there would be catastrophic for the entire tech sector. Trigger 4. A banking or credit crisis. Regional banks are still fragile. If one of them fails and spreads fear through the system, money will flee risk assets including AI stocks. Trigger 5. A simple shift in sentiment. Sometimes bubbles burst for no single obvious reason. The selling just feeds on itself. Once the momentum breaks, the algos start selling, the margin calls start hitting, and the panic spreads. In the bubble burst scenario, the Nasdaq drops 30% or more. The speculative AI stocks get cut in half or worse. Companies that are not profitable go bankrupt. The big names like NVIDIA might drop 40 to 50%. The difference between a correction and a crash is that in a crash, the selling becomes self-reinforcing. Which scenario is more likely? I think we are in a middle ground. The next 12 to 18 months will probably look like a soft landing for the big profitable AI names. But the speculative garbage is going to get destroyed much sooner. If you are holding stocks with no earnings and no revenue, you are gambling. And in a bubble, the house always wins. My base case is a 15 to 20% correction in the Nasdaq over the next 6 months, followed by a recovery led by the profitable AI names. But I am not confident enough in that base case to ignore the risks. That brings me to part 5, your detailed action plan. This is the most important section, so listen carefully. I am going to give you specific steps, specific numbers, and specifics. Step 1. Do not sell everything. That is almost always a mistake. The market could run another 20% from here before any serious pullback. If you sell everything, you will watch from the sidelines and then FOMO back in at the top. That is the classic retail investor mistake. Instead, I want you to adjust your positioning gradually over the next 4 to 6 weeks. Step 2. Identify your speculative positions and trim them aggressively. Here is my rule. Any stock trading at more than 15 times sales with no path to profitability in the next 2 years is a speculation, not an investment. For those stocks, I am taking at least half of my position off the table right now. If you have gains, take them. If you have losses, consider whether you want to ride a potential 50% drop in a name that might never recover. I am not saying sell all of them, but I am saying that the risk-reward on speculative AI names is terrible right now. Step 3. Decide on your core AI holdings for the big profitable names like NVIDIA, Microsoft, and Amazon. I am holding my core positions, but I am not adding at these levels. Instead, I have written down specific buy targets. For NVIDIA, I am a buyer at $400. That is roughly 25% below current levels. For Microsoft, I am a buyer at $350. For Amazon, I am a buyer at $150. I add if they do not hit those levels. I do not chase. Having a plan removes emotion from the equation. Step 4. Rotate into defensive blue chips. Think companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, PepsiCo, McDonald's, and Walmart. These stocks do not move much when AI is ripping. But when the rotation comes, money flows out of tech and into these names. They also pay dividends. Coca-Cola pays a dividend yield of 3%. Johnson & Johnson pays 3.2%. Getting paid 3% while you wait for the next buying opportunity is not a bad deal. I am targeting 15 to 20% of my portfolio in these defensive names. Step 5. Hold more cash than usual. Cash is a position. Too many investors think cash is trash. But cash gives you optionality. When the market drops 20%, you will wish you had cash to buy the dip. Right now, I am holding roughly 25% of my portfolio in cash or short-term treasuries. That is higher than my usual 10%. Not because I am predicting a crash, but because I want to be ready if one happens. And here is a pro tip. Put your cash in a high-yield savings account or a money market fund. You can earn 5% risk-free right now. That is not nothing. Step 6. Look at inverse ETFs or put options if you want to hedge. This is for more advanced investors. If you are genuinely worried about a crash, you can buy an inverse ETF like the PSQ, which goes up when the Nasdaq goes down. Or you can buy put options on the QQQ. I am not doing this myself because timing the market with derivatives is extremely difficult. But if you have a large tech portfolio and you want insurance, these are the tools. Just understand that they come with their own risks. Step 7. Watch the bond market every single day. The 10-year Treasury yield is the most important number you are not paying attention to. When the 10-year yield goes above 5%, money flows out of growth stocks and into bonds. If we see yields spike again to 5% or higher, that will be the trigger for a larger tech sell-off. I check the 10-year yield every single morning. You should too. Step 8. Set your rebalance dates. Do not try to time the bottom. Instead, decide ahead of time that you will rebalance your portfolio on specific dates. For example, you might decide to add to your AI positions on the 1st of every month regardless of price. Or you might decide to add more cash to your portfolio every time the Nasdaq hits a new high. Having a schedule removes the emotional decision-making. Step 9. Review your tax situation before selling. If you have large capital gains, selling could trigger a big tax bill. In that case, it might make sense to hold through the correction rather than paying taxes now. Talk to a tax professional about your specific situation. Do not let the tax tail wag the investment dog, but also do not ignore the tax implications entirely. Step 10. Write down your plan. This is the most important step. Write down exactly what you are going to do if the market drops 10%. Write down what you will do if it drops 20%. Write down what you will do if it drops 30%. When the panic hits, you will not be thinking clearly. That is why you need a written plan today. Let me summarize your action plan in 3 simple bullet points. 1. 2. Buy defensive dividend payers. 3. Hold more cash than you think you need. That is not a bearish portfolio. That is a prepared portfolio. Now let me add one more thing. Do not forget about your own personal situation. If you are 25 years old with a steady job and a long time horizon, a market crash is actually a gift. It lets you buy great companies at discounted prices. If you are 60 years old and planning to retire in 2 years, a market crash is a disaster. Your action plan should depend on your age, your income, your expenses, and your risk tolerance. There is no one-size-fits-all answer. For younger investors, I would actually say do less. Do not try to time the market. Dollar cost averaging works. For older investors, I would say be more aggressive with your risk reduction. Trim the specs, raise cash, move to dividends. Your time horizon is shorter, so your margin for error is smaller. Let me also address the question of internet. The AI bubble is mostly a US phenomenon. European and Asian tech stocks have not run nearly as much. Consider adding some international exposure to your portfolio. The Vanguard FTSE All World ex-US ETF gives you exposure to everything outside the US. It is trading at much lower valuations than the US market. If the US bubble bursts, international stocks may hold up better, or even go up as money rotates out of the US. And let me talk about gold. Gold is a classic hedge against market turmoil. It has no correlation with tech stocks. The GLD ETF is an easy way to add gold to your portfolio. I am holding 5% of my portfolio in gold right now. That is higher than my usual 2% again, not because I am predicting a crash, but because I want to be prepared. No, let me wrap this up with a final thought. Whether this bubble bursts next month or in 2 years, the key is preparation, not panic. Fear is what makes you sell at the bottom. Having a plan removes both from the equation. I am currently updating my personal Wealth Lab watchlist to prepare for potential market volatility. That watchlist includes my buy targets for every major AI stock, the defensive names I am accumulating, the cash levels I am targeting, and the specific price points where I will add to my positions. If you found this analysis helpful, smash that like button. It really helps the channel. Also, I am curious. Do you think AI is in a bubble, or is this just the beginning of a 10-year supercycle? Let me know your thoughts in the comments below. I read every single one, and if you have specific questions about your own portfolio, ask me there. I try to answer as many as I can. Thanks for watching Wealth Lab. Stay disciplined, stay prepared. Do your own research, and I will see you in the next one.